Welcome back to Investing Tutorial, your go-to destination for mastering the art of investing. Whether you're a seasoned investor or just starting your financial journey, our channel is designed to provide clear and insightful tutorials on various aspects of investing. From understanding the basics of stock markets to navigating complex investment strategies, we are here to empower you with the knowledge and skills needed to make informed financial decisions. Join our community of like-minded individuals who are on a quest to achieve financial success through the power of smart and strategic investing. Let's embark on this educational journey together as we demystify the world of finance and unlock the potential of your wealth. In the face of economic uncertainties and the impending 2024 recession, the quest for financial stability takes center stage. In this tutorial, we will explore strategic steps to not only navigate but capitalize on the challenges posed by the recession to increase your wealth. The shifting economic landscape demands a proactive and informed approach to investing, and we're here to guide you through the essential steps. From debt management to constructing a resilient investment portfolio, we'll delve into actionable strategies that can potentially transform economic downturns into wealth-building opportunities. Join us as we navigate the recessionary waters and unlock the keys to increasing your wealth in 2024. We think a recession is imminent. By mid-year, the US economy will enter a recession and experience a notable deceleration in growth. There is going to be a day of reckoning for the US economy. You've certainly seen enough in the mainstream media to know that a recession of some kind is probably in the works for 2024. It's likely that interest rates will remain high. Because customers won't have much extra money, profits for large firms will decline. When economic activity declines, you get a recession, which is already occurring in many nations worldwide. Recessions, however, are truly fantastic times for investors to enter the market because they believe that long-term prices will drop as market anxiety subsides, creating fantastic but fleeting chances in the stock market. Thus, let's examine the steps in this video that can help you increase your wealth and succeed throughout a downturn. I just want to emphasize in this video that while the advice is general in nature and may not be appropriate for you, these are the 5 steps you should definitely consider taking on your own personal path to building wealth in 2024. Paying off high-interest debt is step 1, which is crucial to undertake before you ever consider investing in stocks. Although this is frequently discussed in personal finance books, it is especially pertinent in 2024 because of interest rates. Although high rates may be the reason the recession is presenting us with opportunities, we must also keep in mind that interest rates have the potential to financially ruin people. The interest rate you will be signing up to if you apply for a 30-year fixed home loan in India now is 9%, as opposed to 6% 4 years ago. Interest rates are higher now, and many of the most intelligent economists and investors in the world believe that they won't be much lower in 2024. You need to take a step back and assess which of your loans are variable and which are fixed. If you have a personal loan or credit card debt with a very high variable interest rate, it is usually a much better idea to pay that debt off rather than using the money for investments. If the stock market's historical long-term average return is around 10% per year, but the credit card is dragging you backwards at 42%. Any rupee you have is better spent paying down that debt, so that's the big step 1, and it's particularly relevant right now. But then the next step to building wealth in a recession environment is to consider building a really solid base of long-term passive investments. Warren Buffett, the world's best active investor, even recommends this step. Now, this is not a particularly exciting step, but it will be the engine room of your future wealth. Passive investors choose other stocks to add to their portfolio instead of depending just on stock selection. Instead, they opt to purchase a small portion of everything, spreading their chips around the market, and then they cross their fingers, hoping that when firms prosper and the market as a whole rises, their stock portfolio will rise along with it. This is how they envision the future of corporate India. Of course, this isn't guaranteed, and when it comes to investing, keep in mind that past results aren't always indicative of future results. However, in general, passive investors have faith in that. They believe that corporate India's future will resemble its past, and this is a cunning little tactic because it balances out your portfolio. Large swings in an investor's portfolio are common for individual stock pickers. However, with passive investing, such as using the Nifty 50 index, your money is spread across 50 companies, Some may lose, but even if you hit a few bad ones, your portfolio isn't destroyed. Instead, what matters is the market's performance over an extended period of time. Thus, that is unquestionably the second stage in leveraging the recession of 2024 to create riches and begin introducing money into the market more widely. Thinking ahead 20 to 30 years, but there's undoubtedly more to it than that. In fact, for many people, it may be as far as they're willing to go in terms of investment, and that's perfectly acceptable. However, there will also be a tiny percentage of people who want to go out and look for chances, conduct study, and seize the larger ones that a recession frequently presents. These are the world's active investors. They examine individual companies and wait patiently for chances to acquire excellent companies at a bargain. Recessions are particularly excellent at providing those kinds of conditions. Without a doubt, recessions can present investors with enormous chances. In 2020, were the largest investors in the world buying or selling? They were buying in 2008, they were buying in 2001, and so on. However, in order to accomplish this correctly, you must be aware of two crucial stages, which leads us to step number 3. Analyzing the balance sheet to make sure the company has plenty of cash on hand and few obligations. Businesses with large financial reserves are better equipped to contain unavoidable spot fires that arise in challenging economic times, whereas those with little resources and a heavy debt load are more susceptible to failure. The same is true of our personal balance sheets. If we are debt-free and have cash in the bank, we are doing okay. TCS has idle cash of almost 100,000 crores, which they might utilize to repurchase shares. But first, let's take a look at their obligations. With merely 7,000 crores in debt, they can pay it off quickly. They can also make acquisitions and even provide support to other groups of businesses. Having cash on hand is crucial, and given the current situation, this is a huge advantage. The current liabilities to the current assets, which is a very good indicator. However, consider a different business, such as Hindustan Unilever Limited, which has reserves of 50,000 crores and around 1,200 crores in debt. In the few days, they would be able to pay off the debt of just 1,200 crores, thanks to their reserves of 50,000 crores. Therefore, in 2024, investors looking to locate opportunities in the market need to be aware of cash and debt. In a high interest rate environment, it is extremely difficult for a corporation to go bankrupt if it has lots of cash on hand and no debt. That brings us to step 4. Carefully examine every company you come across in search of a competitive advantage. There are many different kinds of modes out there. Apple has a brand mode. Warren Buffett referred to this as a business's modes. These are the modes surrounding the castle that keep intruders at bay. There is a switching mode in Microsoft. Coke offers a secrets mode. Finding a company with pricing power, the capacity to raise rates for customers without suffering negative consequences, is crucial while facing challenging economic times, since it helps sustain your business while other companies falter. The most expensive cola drink available, Coca-Cola, has been raising prices over the past few years. However, did their sales suffer as a result? No, they have enough pricing power and a strong enough mode to raise prices without significantly impacting inflation. As for the Apple tax, we've all heard about it. Although many tech reviewers have demonstrated that the iPhone is not the best value for money, sales of the device still exceed those of any other smartphone. Take a look at where your company's sales and profits have fallen over the last 4 years. If they've taken a significant hit, it's possible that the company you're looking at lacks pricing power. However, if the company is still putting out really strong results, despite all we've seen over the past few years, chances are they've got something going. Take a look at Microsoft since 2019. Their revenue has increased, their net income has increased, and there have been no problems. Inflation has gone crazy, interest rates are currently very high. Still no effect, they simply carried on as usual. Resilient enterprises are what we're looking for. Thus, the fourth stage is to simply keep in control of your emotions. The amazing thing about investing is that it's not that difficult. Passive investing is as easy as it gets, and most people can even identify quality companies and manage valuation models. The issue most investors face is having a bad investing temperament. In recessionary times, this is especially problematic because the market becomes extremely erratic. People are always telling you to sell, and things are more volatile. It's also simple to panic sell during these times. The most crucial thing to keep in mind, though, is the famous quote from Warren Buffett. Don't hold something for 10 minutes unless you're willing to hold it for 10 years. The idea behind really skillful long-term investing is to plan out an investment holding period of more than 10 years. After all, the purpose of investing during a recession isn't to make a trade or even to increase your wealth in the short term. Rather, it's to acquire a good entry point and start from there. Thus, if we purchase a high-quality company at a competitive price, and it subsequently declines by another 20% right away, that's great because we didn't intend to sell it for 10 years. Instead, we're just taking advantage of the current unrest to get in, so that once the economy stabilizes, our company can grow, and the unrest will no longer be relevant. That's the fifth crucial step. Encouraging viewers to engage with the video content is not just a routine request. It's an invitation to foster a sense of community and knowledge sharing. When you appreciate a video, it's a testament to the value it brought to your understanding. The line, "If you like the video, please share with your friends and family members and hit the like button," so that they also can get some knowledge about the steps to get rich during a recession, embodies the spirit of communal learning and empowerment. Firstly, the call to action to like the video is not merely about accumulating digital thumbs-ups. It signifies that you found the content informative, engaging, or thought-provoking. By hitting the like button, you're contributing to the video's visibility within the platform, making it more accessible to a broader audience. The subsequent request to share with your friends and family members amplifies the community aspect. It suggests that the insights provided are not exclusive to the individual viewer, but are valuable enough to be disseminated among those closest to them. Sharing becomes a gesture of generosity, a way of saying, "I found something beneficial, and I believe you will too." The final part of the statement, so that they also can get some knowledge about the steps to get rich during a recession, outlines the underlying purpose. It's an acknowledgement that the information shared is not just about personal gain, but about collective empowerment. The video aims to equip not only the primary viewer, but their social circle as well, creating a ripple effect of financial literacy and strategic thinking. In essence, this line encapsulates the ethos of knowledge dissemination and the belief that shared insights have the potential to uplift entire communities. It transforms the act of interacting with a video from a solitary experience into a catalyst for shared learning, making the pursuit of financial wisdom a collective endeavor. Finally, you can register a DMAT account through Angel One if you intend to invest in the stock market. There is a link in the description. That concludes our discussion for now. Till then, goodbye. I'll see you in the next video.